Imagine a material so vital, its presence is woven into the very fabric of our technological and sustainable future. It's in the solar panel that powers your home, the sensor in your smartphone, the circuitry of the latest fighter jet, and even the bandage that heals a chronic wound. Now, imagine that this same material is traded on global markets with a psychology that seems completely detached from this massive physical demand. Its value is often dictated by the whims of financial algorithms and the shadow of another, shinier metal. This isn't a hypothetical scenario. This is the profound and growing paradox of silver in the 2020s. The fundamental relationship between price, supply, and demand, the very bedrock of commodity economics, appears to be fracturing for this ancient metal. We are witnessing a historic clash between silver's timeless role as a monetary asset and its explosive new identity as an irreplaceable industrial commodity. The market's inability to reconcile these two identities suggests its foundational pricing model might be broken, setting the stage for unprecedented volatility, supply crises, and a potential reckoning that could reshape entire industries. For millennia, silver's value was linked to jewelry and currency. Its allure was its beauty and rarity. The 20th century introduced a new dimension. Photography consumed vast quantities of silver, yet when the digital revolution wiped out that demand almost overnight, the market absorbed the shock because silver's identity as an investment metal remained dominant. The turn of the 21st century, however, has initiated a silent second revolution, one that is far more voracious and structurally permanent. Today, silver is the world's most conductive element, and we are building a world that runs on conductivity. This isn't just about a few niche applications. It's about the central pillars of modern economic strategy, the green energy transition, digitalization, and advanced technology. The most powerful force rewriting silver's demand ledger is the global push for decarbonization, specifically through solar power. A typical solar panel consumes about 20 grams of silver paste, a conductive layer critical for collecting and transferring electricity. As the International Energy Agency reports that solar PV accounts for a staggering 3/4 of new renewable capacity growth, the arithmetic for silver becomes breathtaking. In 2023, the solar industry consumed over 160 million ounces of silver, a figure that has more than doubled in a decade and now accounts for roughly 15% of total physical demand. The Silver Institute estimates this could climb to over 200 million ounces annually by 2030, driven not just by more panels, but by next-gen tech like TOPCon cells, which use even more silver per unit. This demand is what economists call inelastic. Manufacturers can't just switch to copper or aluminum without sacrificing significant efficiency and longevity. The energy transition, in short, is built on a foundation of silver. Beyond the solar farm, silver is the lifeblood of our electronics. Every switch, every circuit board that requires reliable, corrosion-free, and supremely efficient conductivity relies on silver. It's in every car's computer, every 5G base station, every RFID tag in the global supply chain. The explosive growth of the Internet of Things, connecting billions of new devices, is a growth story for microdoses of silver. Meanwhile, in the high-stakes realm of defense and aerospace, silver's role is irreplaceable. From the high-reliability contacts in satellite systems to the conductive coatings on fighter jet canopies for de-icing, alternatives simply don't meet the rigorous standards. This industrial demand paints a picture of a metal whose fate is tied to global GDP growth, technological advancement, and strategic policy. It is behaving less like a precious metal and more like a critical mineral, a fact formally recognized by both the United States and the European Union. And yet, if you watch the daily price ticker for silver, this story of criticality often feels like a distant echo. The price remains notoriously volatile and, for long stretches, seemingly depressed relative to the scale of its consumption. The primary reason for this disconnect is the enduring power of the paper market. The trading of silver futures contracts on exchanges like COMEX in New York dwarfs the trading of physical metal. Hundreds of millions of ounces are traded digitally every day by banks and hedge funds who have no intention of ever taking delivery of a single bar. Their decisions are driven by things like the US dollar index, interest rate expectations, and most powerfully, the gravitational pull of gold. Silver is often traded as a leveraged high beta cousin to gold. When gold moves on monetary fears, silver tends to move more sharply in the same direction. This creates a surreal dichotomy. The price can be slammed down by a strengthening dollar, even as, in the physical world, a solar panel manufacturer is desperately trying to secure its monthly supply. The paper market tail is wagging the physical market dog. The physical fundamentals create a long-term price floor and a structural bull story, but the short-term price is hijacked by financial flows that are utterly agnostic to whether a mine in Peru had a production shortfall or a new battery technology is increasing silver use. The fragility of this system is exposed when we turn to the supply side, which is struggling to keep pace even with current demand. Global mine production has been stagnant for nearly a decade. Major primary silver mines are rare. Over 70% of supply comes as a byproduct of mining for other metals like copper, zinc, and lead. This creates a perverse scenario. The decision to dig a new copper mine is based on the price of copper, not silver. If copper demand falters, that silver supply never materializes, regardless of silver's own price. This makes supply profoundly unresponsive to silver-specific price signals. Furthermore, the mining industry faces a perfect storm of declining ore grades, rising costs, and intensifying environmental hurdles, which make developing new projects a decade-long, multi-billion-dollar gamble. The low-price environment perpetuated by the paper market actively discourages the investment required to solve the supply crunch. Recycling, often the buffer for metals under stress, is also limited. Unlike gold, a significant portion of silver is consumed in tiny amounts. The small traces in a discarded smartphone or a spent solar panel are currently lost, economically challenging to recover. So, we arrive at the core of the broken mechanism. The price discovery system, dominated by speculative paper contracts, is sending signals that are dangerously misaligned with physical reality. A low price tells the market, no need to invest in new supply, no need to innovate in recycling. But the physical market is whispering a different truth. Every major economy on Earth is launching policies that will lock in exponential demand growth for the next 30 years, while supply is constrained by geology and capital. This is the definition of a fundamental disconnect. The consequences are already beginning to manifest. We're seeing the rise of a two-tier market. On one tier is the exchange price you see on TV. On another is the physical premium. The extra cost buyers pay for actual bars and coins. During periods of stress, these premiums can explode, even if the headline price is flat, indicating a shortage of deliverable metal. Industrial consumers are now seeking long-term direct supply agreements with miners, bypassing the exchange price altogether, a classic sign of a market losing faith in its own benchmark. The inevitable result is an inventory drawdown. Global visible stockpiles, like those in COMEX and London vaults, have been trending downward for years. The buffer is shrinking. When a critical commodity hits a true stockout condition, where a manufacturer cannot source material at any price, the price reaction is not linear, it is explosive and disorderly. The paper market, built on the assumption of infinite liquidity, would face a catastrophic short squeeze. We stand at a precipice. The silver market is suffering from a kind of schizophrenia, with its monetary past and industrial future warring for control of its price. The old fundamentals are obsolete. The new fundamentals tell a story of criticality, inelasticity, and structural deficit. History shows that when a market's pricing mechanism persistently ignores physical reality, the eventual correction is violent and transformative. Silver is not just a shiny metal for investors to speculate on, it is the conductive thread stitching together our digital and green future. The market has yet to fully comprehend this, and until it does, the dangerous rift between price and criticality will only widen, waiting for the catalyst that will force a fundamental reckoning. Thanks for watching. If you found this breakdown insightful, be sure to like, subscribe, and hit that notification bell for more deep dives into the forces shaping our world. See you next time.